Hello everybody, welcome back to another valuation investing video, and today in this video, I'll be going over Fiserv stock. And as we can see here, Fiserv had a very rough past earnings report, and I made a video on that, and that is the biggest, most popular video I've ever made. So I'm gonna make a follow-up on that video, and let's get into Fiserv stock and to see, can this company ever rebound in the future, and to get in some of the recent news coming out about Fiserv. So with Fiserv, as we can see, year to date down 72%. And as you can see here, you're going to say this is in euros. So actually right now Fiserv is in the middle of changing their stock ticker, so we'll get into that a little bit later, but they're right now changing their stock ticker, so it's not really coming up online. But taking a look at that very important earnings report, which was very bad, significant earnings miss and huge guidance cuts for this company. Earnings miss, looking at the earnings miss, reported adjusted EPS $2.04. That missed by 60 cents. Analysts were expecting around $2.64, so this was terrible. Organic revenue growth, only 1% in the quarter, far below expectations, so their growth is terrible. Earnings per shares missed, everything missed. Also, the guidance cut. New organic revenue growth forecast 3.5% to 4%, cut from a previous projection of about 10%. So that is a huge cut, especially in one earnings. I don't think people realize how big of a cut that is. That is huge. If you even see a 1% cut in their projected revenue growth, that would be terrible. But this is cut by about 6 to 7%. So this is a huge cut. Also, the EPS cut about 20%. They reported they have new adjusted EPS forecast of $8.50 to $8.60, previously around $10. So that's also very bad. And take a look here, operational issues and management admission. They've been overly optimistic assumptions. The prior guidance was based on growth assumptions that were almost objectively too difficult. Short-term focus, the company had previously been deferring investments and cutting costs to meet short-term margin targets. So they've been basically deferring investments in accounting issues. They've been technically accounting a certain way in order to make it look like they're making more money than they actually are to serve their clients and execute their product launches. And with that, they also said volatile market reliance. Fiserv cited the slowdown in its operations in Argentina as a major drawdown. So that is not good. Taking a look at the leadership and governance shakeup of Fiserv here, this is another big news here for Fiserv in that recent earnings. The bad news was compounded by a sweeping change in leadership. As we see, the CFO is going to be leaving the company. The company announced that the CFO would be leaving and a replacement was named. The board refreshment, significant changes to the board of directors was announced. Also, executive reorganization, structural adjustments, including the introduction of a dual presidency model, were unveiled. So the entire leadership of Fiserv is being changed. So that obviously made the stock tank, but I honestly think this is a good thing. Well, obviously, it's not necessarily good because that shows that the past wasn't doing good and there's uncertainty. Like I say in almost every video, the stock market is based on the valuation and fundamentals of the company, number one, and their earnings per share in the future. And that's where the company and stock is mainly based on valuation. But also another main thing is based on the uncertainty or future of this company. If something's uncertain about a company, the stock will not be doing good. The better the predictability of a company or a stock fundamentals in the future, the better the stock will be doing. And another bad thing here is we have Fiserv shareholders suing. Also, Fiserv CEO is denying accounting irregularities amid company reset and forecast slash. So there's some rumors going around that they did some accounting irregularities, which could be bad for this company, and a lot of shareholders are trying to sue. Taking a look at the change in the ticker, like I said earlier, previous ticker was FISV, new ticker was FI. Now they're going back to FISV to return to its heritage exchange, often cited as a move to align with other major technology companies. Going over to the biggest thing I do not like about this company, Fiserv, is the amount of debt this company has and their reliance on acquisitions. So looking at the most critical event driving Fiserv's current debt structure was its $22 billion all-stock acquisition of First Data Corporation in 2019. Strategic rationale: Fiserv was traditionally focused on providing core banking software to financial institutions and was a global leader in merchant acquiring and payment processing. The merger was intended to create a one-stop shop that could offer integrated solutions to both financial institutions and merchants. So with that acquisition, they got Clover, a point of sale system for small businesses, which is a very fast growing segment of this business also, which is the only real good thing about this business. But looking at the debt impact, they assumed over $17 billion of First Data's pre-existing debt. So this is huge debt for this company. Went from $6 billion to $21.6 billion in 1 year. That's the one thing I don't like about this company. Also, taking a look at the debt management strategy, the massive debt load requires a disciplined financial plan, which Fiserv has consistently stated its focus on deleveraging and leveraging its combined free cash flow, deleveraging and free cash flow. The goal is the primarily financial goal following the merger was to rapidly pay down the debt using the free cash flow generated by the combined entity. The company targets a net debt to EBITDA leverage ratio around 3x, so that's around where we want it to be, and that's their management projected achieving significant cost synergies and revenue synergies. So to boost the free cash flow to pay off debt, and they're prioritizing that. But we'll be getting into why I don't think they're really prioritizing that enough. Take a look at the SWOT analysis on market-io for Fiserv here. As we can see, they've been having some strategic acquisition expansion, like I said, and their Clover platform dominance is the only thing that I really like about this company. Some weaknesses: consumer spending slowdown. Obviously, like we've had with that earnings report, that's a huge weakness. So with that being said, let's go over to my investing website, put in Fiserv stock. Going down here, the market cap right now is at 34 billion. The PE ratio is 9. This is a very low PE ratio for this company. This means you're paying $9 for $1 of earnings per share. This is insanely low. Free cash flow yield insanely high, which we like. So these are very good valuation metrics, but for the company, the slow growth and everything, it just doesn't look great. The balance, net cash, negative almost $30 billion. This is the thing I just don't like about this company. There's over $30 billion in debt. And the market cap is about the same as the amount of debt. It just doesn't look good. 4P ratio is good. Return on invested capital isn't. The growth numbers look good, but after these recent quarters, it's not going to look good. The shares outstanding is decreasing. Like I said, they're going to be they said they want to prioritize paying off debt. However, with that being said, the debt to free cash flow at this high, and then taking a look at the shares outstanding. Guess where most of that free cash flow is going? The shares outstanding. They said they want to prioritize paying off debt, but yet they're buying back this many shares. This doesn't make sense. You should be focused on paying off their debt and not just buying back this many shares. I love buybacks, but in this situation with this much debt, you have to be paying off debt, and now it's just really a bad situation for this company. So going over to the intrinsic value calculator here, let's input some assumptions. Bear case, let's do a 2% growth. Base case, let's do 4, bullish case 6. They're expected to grow about 4% in the next few quarters, so I think this is fair for Fiserv. They could probably get up to maybe 7 to 8%, but I don't think so. I think this is pretty fair for this company. Future profit margin, right now it's at 17%, and that has been decreasing. So I'm going to put 12. Base case, I'm going to put 14. Let's do 15, and then bullish case, let's actually put it a little higher than what it is today. I think base case is going to decrease. I think it's just going to decrease. Now, bear case PE ratio, I have to put a PE ratio of 8. Base case, I'm going to put a PE ratio, let's do 12. Bullish, let's do 12. Bullish case 16. I think that's fair for this company. Shares outstanding, I think they're going to be buying back fast. So I think let's do 3, 4, and then 5%. So with that being said, calculating the intrinsic values here, we can get almost a 10% return with this company. But me personally, I just think the risk is not worth this company. The debt looks terrible. The growth looks terrible. Me personally, I'm staying away from this company. It just looks too scary of an investment. When I mean too scary, it's just the fundamentals just do not look good. The balance sheet just doesn't look good. With that much debt and slow revenue growth, their interest rates, people have told me, is around 3 to 4%. So with that being said, it doesn't seem bad. But when the revenue growth is growing less than the interest rates, it's just a lot of disaster about to happen. And me personally, I'd be staying away from this company. It's just not looking good. So thank you guys for watching this video on Fiserv stock. Please subscribe, hit the like button. If you want to go check out valuationinvesting.money here, this website, go check it out. Click here. You can sign up with a 7-day free trial. So go ahead and check that out. And thank you guys for watching, and see ya.